I don't see that happening today. I think that's a huge difference between the two markets. First of all, people have more equity today than they've had in a long time in their homes. Granted, due to the large appreciation that we've had. But even when things start to drop here, we're still in a good spot because for the last, however many 10 years, we've been making really good loans.
Hey everybody, for this week's video, I sat down with Kelly Allen of Synergy One Lending. She's the area manager of all of Idaho and Washington and has been in the lending business for 30 years. So I wanted to ask her thoughts on how what we are seeing in today's Boise housing market relates to what we saw back in 2008. So I hope you enjoy our discussion, and a special thanks to Kelly for sitting down with me. So let's just kick it off. How would you describe, as a lender, from a lender's perspective, what has happened here in the Boise housing market over the past 6 months?
Well, certainly we've kind of been hit upside the head with a halt, right? From the party we had the last couple of years. Somebody explained it to me recently. They thought, it's like we've been at a party for 2 years and all of a sudden now we're facing the hangover. And I think that's pretty clever, and I think that's pretty true. And that's what it feels like for sure. When you go so fast and furious for so long, and then all of a sudden something happens and it drops. We knew this was coming. I mean, this shouldn't be a surprise to a whole lot of people because you can't have the good days forever, right? One thing we know about market cycles is they go up and they go down. And so you can't have the good days forever, but we certainly didn't feel like it was going to come this hard, this fast. And so I think that's the surprise.
But let's kind of relate it to 2008. How have the lending standards changed since that very big the Great Recession of 2008?
Well, dramatically. And if you've gotten a loan in the last, 5 years even, you would know that because it used to be pre-2008, we had fast and easy loans, we had no doc loans, we had bank statement loans, we had all sorts of different products.
So let me slow you down. Let me stop you for a second because that's interesting. Now, if you apply for a loan, you need to give, a W-2, you need to verify income, you need, all of this stuff.
Yep.
Did you not need any of that in 2008? I mean, literally, I could call you up and say, I make X amount of money, and you would say, great, I'll take your word for it?
Possibly. Yes, possibly. There was a product for that had you needed it. Yes.
Wow.
So dramatically different. Now, and post-crash, all of those products, if you want to call them high-risk products, went away. And we went completely... It's very common in the mortgage industry for the pendulum to swing, right? So we were way over in left field with anything goes, and it went all the way to the right, where everything was needed. And so for a long time post-crash, we were over-documenting and getting every single thing that, you could get to do a loan. I would say in the last, 5 or 6 years, we have had a really good run of what you need to get a loan, right? You need good credit. And if not good credit, they're going to make up for it in some other way, whether it's rate or cost.
If somebody would ask you, how does today compare to 2008? What would you tell them in like 5 sentences?
Well, in 2008, you have to remember prices were declining pretty rapidly, and people didn't have a lot of equity in their homes because we had just done all those loans with, no bank or no income, no, just your bank statement, whatever. And little money down. So you go in with little money down, then the market drops, which nobody thought ever would happen, right? And all of a sudden you own an asset that is you owe more on than it's worth. And that freaked a whole heck of a lot of people out. So people either couldn't afford the payments anymore and they foreclosed, or you might not have been in the place where you couldn't afford the payments anymore, but because your neighbors and everybody else was foreclosing, you just jumped on the bandwagon. You thought, why am I going to keep this asset when I owe more than it's worth? Which was really short-sighted and bad thinking, because if you had just hung on, right, got to have a house anyway, got to have a place to live. It really doesn't matter what your house is worth unless you go to sell it. So we had a lot of people jump on that bandwagon, and then the foreclosures went through the roof. I don't see that happening today. I think that's a huge difference between the two markets. First of all, people have more equity today than they've had in a long time in their homes. Granted, due to the large appreciation that we've had. But even when things start to drop here, we're still in a good spot because for the last, however many 10 years, we've been making really good loans. People have come into the loan with equity. And now through appreciation, even if it was just regular 3 to 4 to 5% a year appreciation and not the... what have we had, 40% that we've been going through, they still have that equity built up in that home. And so they're not going to be sitting there on an asset that they owe more than it's worth. And so there's a couple of things to do with that. You can obviously utilize that equity if you need to. You can just hang on and sit there and make your payment. You've probably got a 3-year 2 or 3% interest rate on your loan.
Right.
So that's all good and dandy, and you hang tight with that. And let's just kind of ride this next wave out and see what happens. But those are the two main differences I see. Now, from a lending perspective, I will tell you, there's still fear, right? There was fear then, there's fear today. The fear today is more based on when's it going to end, and how high are we going to go.
So when is it going to end, and how high are we going to go?
Well, that's the traditional, I don't have my crystal ball answer. We're looking for a spring buying season next year, hopefully, right? So if we can get rates even in the 5% range, I think that would be amazing. Right now, we're hovering in the 7s, and if we can stop there and just, maybe hang for a little bit and then come down to the 5s, that would be what I would call a win. What will not be a win, of course, is if we bump past that 7% range.
Yeah. So what's the lowest that you've ever locked somebody in? And then what's the highest you've ever done?
Well, the lowest that I can remember from the heyday was about 2%, and that was like on a 15-year loan.
That's crazy.
Yeah.
Wow.
I always used to say almost free.
Yeah.
Almost free money.
It's literally almost free. So that was like last year, a year and a half ago, maybe.
Yeah, maybe a year and a half ago.
And what would be like the highest interest rate you ever locked somebody in at?
Well, most recently, I'm going to say high 6s. So
or even ever. I mean, has this been the highest since you?
Well, I will tell you, when I started back in 1992, rates were in the 8s. And so, yes, there was plenty of loans done in the 8% range at that time. But most recently and today, I'm going to say right below 7, 6.99, 7%, something like that.
Where would you say the interest rate could be in the middle of next year?
Well, here's what we do look at is we look at, the charts just like you do. And I think that we will see, if we get lucky, if they get inflation tamed and under control, I think we will see going into next year possibly that 5% range. If we can do that, and if the prices soften, I think we will have a spring buying season. Because again, people are going to buy a house. The best time to buy a house is when the time is right for you.
Right, exactly.
It's not timing the market. It's when the time is right for you, when the time is right for your family and your job situation and all those other things. So going into this recession, or if we're in a recession already, depending upon who you talk to, I think a large part of it's going to be, how many people are going to lose jobs, what kind of income decreases are we going to see, and that kind of thing. Because that goes hand in hand with if you're in the moment to buy a job. Are you in the mode to where you need to buy a house? Do you have the ability to make a payment? And that's what it's all about.
Right.
Because we're not going to see no doc loans again. We're still going to have to qualify. We still have to have full income. You have to have good employment, those kind of things. So how hard is this recession going to be on jobs overall? And then couple that with the softening of the prices and the rates kind of leveling out. If we can get those all in line, I think we will have a spring buying season.